Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Dimitri, Market Chameleon, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage. How you doing, Dima?
Good morning, Will. How are you?
All right, let me share your screen with that beautiful new Market Chameleon landing page. And
Good
stage is
morning,
all yours,
everyone.
buddy.
So today we'll go over an option trade with a stock contingency. So we'll take a look at an example. We'll find one, and then we'll just discuss, what the stock component is, why somebody would use a stock component to an option trade. So first, I'm going to navigate under options. We're going to look at the options volume report to detect some stock contingent trades, and then we'll go and analyze it. So as you can see, this report here, it lists the available stocks, the stocks that have options available to trade. And if we go from left to right, it gives us some data for each of these symbols. You can see here on top Oracle, and if we go from left to right, we get a bunch of data. But here at the end, this is a breakdown of the option volume. So we have the option volume for Oracle, and the breakdown is single leg option trades. 79% of the volume were just a single leg trade buying a call or put. Then 20% were option trades that involved at least one leg or more. So when you enter in a spread, a call spread or a put spread, you need at least two legs executed simultaneously on that trade. It could be, a butterfly that has four legs, but it's more than one leg. Then we have this other condition that has a contingency, which is usually a stock. And here you could see in Oracle is only 1%. And, typical contingency most people are familiar with is a buy right. So if you want to actually execute a buy right, a stock you may not own, but you're considering it, and you want to do the trade simultaneously, where you buy the stock and sell a call at the same time, because you don't want to risk legging into that trade, because if you buy a stock first and it falls, then by the time you sell the call will be worth less. If you sell the call first and then try to buy the stock, well, you could sell the call. If the stock goes up, now you're buying the stock for a higher price, and the call that you sold is worth more that you're losing on that call. So when you execute the buy right, where you're saying I need the stock price and the option price simultaneously, at this limit, that means you need both legs executed at the same time. So that would be a contingent. You don't want to sell the call unless you have the stock as well. But there are other contingencies like delta neutral and so forth. So let's take a look at maybe one. And what I'm going to do is first let's look at options with at least 1,000 contracts or more that traded. So we're going to use some filters here. And when I do that, you could see now we filtered, there are 1,279 stocks that traded over 1,000 option contracts out of 5,780. And by clicking on these columns, we could sort by any of these columns. So let's click on contingent. And Let me click again to do highs to lows. So you could see here that Sandix Pharmaceuticals, SNDX, that traded. Let me click on the volume instead of notional, just contracts. So today or yesterday, we're not open yet, traded 7,683 contracts, and 78% of these contracts were involved a trade that was contingent. So when we look at it, keep in mind that we still have to go and find this stock trade. So you need multiple feeds. Okay, you need the feeds to the options trades, you need the feeds to the stock trades, and then you have to kind of sync them up. You know, you have to synthesize all these to try to figure out what's going on. You know, here's an options trade where it says it's contingent. I got to find and match things up. That's what we do here for you. Our system is looking through this and matching it up and then organizing it. So let's click on this 78%. It's going to take us to the multi-leg trade screener because a contingent is still a multi-leg in the sense that you need more than, it's not just a single buy or call or put, you need some other component to it. But let's click on this 78%. This takes us to the, you can see multi-leg trades, okay? And we're gonna go look for this trade. So here we see at 10:33:48, we see 6,000 contracts traded. It looks like some kind of a combo. So it had 3 option legs, including a call, a put combo, and it was tied to a stock of 100,000 shares. Okay, so the system kind of found all these components that happened, put them together. So let's see, I'm going to open this up just to see what we think may have happened here. So I'm going to click open. And, you know, here's the trade, but we're going to click on these details. And now we see all the details in front of us. So we see the 3 legs, right? 3 legs of the option. And we know there's 100,000 shares tied to this. You know, so here we go, the stock contingent part. So let's try to figure out here what may have happened with what, you know, what was the rationale perhaps behind this trade. You know, what was perhaps the intent of the trade? Because as traders, we want to know, how are people using it? What are people doing here? What are perhaps the current open positions in the stock? And what both sides do. So here we see that there are 2 puts that traded. And a call, okay, and we do see that there is 2 different expirations. That's why it's a calendar spread, right? So we see that the put itself has 2 different expirations. So it's kind of like a put calendar spread, and it also has different strikes. So all 3 different strikes. Perhaps this is a put. Actually, let me open this up for a second. So this doesn't. So this looks like it's an opening position. I'm going to just close this for a second. So here's what it looks like. That if we just looked at the bids and offers, it looks like if you're buying based on the 215 price and the 215 ask, it looks like you're buying a put with a higher strike, right? The 16 put, selling a put with the lower strike in Jan 16, right? The 95, selling it, the strike is 90, the price is 95 cents, which matches the bid. And here the call trading at 85 cents is closer to the bid side. So just looking at that, it looks like you're kind of buying a put spread that's counted like a diagonal, where you're buying a higher strike put, selling a lower strike. So you're buying like a diagonal put spread, kind of getting short, selling a call, getting short. So if you were going to hedge that, right? So you're looking at a position potentially that, from one side is getting short, one side's getting long. But let's just look at it from this side that you're getting short, because if you're buying a put spread and selling a call, well, now you have a position that you're short deltas, right? That position benefits if the stock goes down and expected to lose if the stock goes up. And we could kind of see, well, what is the approximate deltas? Well, we see here you got 40 delta, 20 delta, and then the 24 delta. So just doing it in my head, if you're buying the 40 delta, selling the 20, you're getting short 20 delta. Here you're getting, if you're selling this, you're getting short 24 delta. So about, let's say, 88,000 delta, 90,000. So this is why we see probably the 100,000 shares, which is mitigating that risk. So what this is telling us is that using the data that's in front of us and available, this trade looks more like not a directional necessarily bet, because there's a stock component. The stock component looks like it might even, be a little bit longer delta, even though you're getting short by selling a call, buying a put spread. But at the same time, you're saying, well, wait a minute, I'm also buying some stock, kind of like like you would think like a buy rate, where it looks like the stock component is actually making him a little bit longer delta, because just based on our delta, you'd get short around 88,000 delta. But if you're buying 100,000 shares of stock, you're net long a little bit of delta. So think of it as like, if you're buying a put, selling a call, buying stock against it, right? So if you're selling now, buying it out of the money put, selling it out of the money call, buying stock. Here you're kind of doing it with a put spread. And that's kind of the takeaway from this very large trade. So you could see here it's involved 6,000 contracts, which, was the majority of the option volume from yesterday. Out of 7,600, you got 6,000 contract just in this trade alone. But then when we analyze it, and add the stock component, it really looks more like a little bit of a sentiment with an upside call, where he's selling an upside call at the 25 strike, and buying a put spread with a 16, 12.5 strike. So we're going to stop right there. Wanted to just go over an example of a contingent trade.
That's great, Dean. And really, Serge was asking, he's trying to understand why you'd want to do it. And it's really just to get an understanding what's trading in the market, right?
Yeah. So we let's just, look at this trade. If you're buying a stock, right? So you're buying 100,000 shares of stock. Well, if the stock's right around 1650, right? So What's happening here is you're buying 100,000 shares of stock, and if it floats up to, the strike price of 25, you're kind of, you're good, right? Because you're made all this appreciation in the stock, right, from 16 to 25. It'll be offset. It does look like you're net paying something here, 215 minus, you collected 95 cents and you collected 85 cents. So, so what were you here? About $1.80. So you're paying, what, 35 cents for the whole thing, right? Net paying 35 cents. So if it goes up, you're definitely, benefiting from this 100,000 shares of stock that you're long, right? It'll offset whatever you paid 35 cents. But what if the stock goes down and you're wrong? Well, now you're hedged at the 16 strike, right? So if it goes below 16, you're losing on your stock, right? You're losing on your stock. You have 100,000 shares of stock, but now your put kicks in, and you have 2,000 of them, right? So 2,000 of them will start offsetting the 100,000 shares of stock, right? Because you got, it's like 2 to 1, right? For every stock you have 2 puts. So that will start offsetting, and that's good until you hit that 12.5 strike, right? So at 12.5, now you're short. So that put spread. So what will happen is, at 12.5, that's the put spread. It stops at 12.5, but you still have that 100,000. So I think that this person feels that, and I don't have time now, but maybe we'll come back to it and let's set it up in a payout diagram. But it feels like there's upside up to the 25 strike, right? And if there's downside, it's somewhere around the 12.5 strike.
Yeah. Actually, people thought you were using the payout diagram and showing it, but you were doing it all in your head, obviously.
Yeah, I was doing it. Yeah, because I could just see the strikes and do the math in my head. But yeah, so anywhere between, really, just if you're doing it in your head, this position stands to make if you're up to the 25 strike and down to the 12.5 strike. It stands to make. I guess if you just sit here, you lose that 35 cents that you paid. But if it starts moving up, or even if it breaks through, that 16 strike, down to 12.5 or up to 25, it stands to make. So, all right, well, I'm gonna.
All right, perfect. Maybe tomorrow we can look at a payout diagram, or you would just link it to it. You would go in and just set it up in a
Yeah.
payout diagram.
Actually, hold on, Will.
Yep.
You didn't tell me this, but it didn't move to the next. I'm looking at the. You know what? Sorry, guys. You didn't see the visual, so I'll go over it again. When you click on it, actually, it took me to another screen. I didn't realize that this.
Yeah, I was trying to ask. Stacy was asking. They were I was wondering if it was on. It should have been on a different screen.
Sorry, yeah, it should have been on a different screen. I didn't realize that I was only looking on my screen, but now I just jumped back and realized it stayed, because what happened is it pops up a new screen. And this is just focus on that one.
Can you show them where the screen is? Where would the screen be? What is the other screen?
Yeah. So the screen. Let me see if I could. So once you, oops. Let me see. Once you click on that, what it does is it takes you over here. So it takes you over here. Here's that trade. And what you do is you open it up. And if you click on these details, this gives you the details of each option leg. Okay, this is what I was looking at. Here's the stock component, 100,000. So, and
Gotcha.
here are the deltas.
So
Yeah,
it breaks down the whole trade.
it breaks down the whole trade. So you could do, yeah. Sorry, I didn't realize that that this did not navigate to that screen. So the whole time I was looking at this screen. That's why it probably didn't make sense to some of the people.
All right. Sounds good. I wonder is that in our is that a fault in the program it didn't flip over, you think? Or because you were seeing that screen on your end.
No, I think the streaming software that we're using will.
Doesn't
So what it does is when I shared the screen, it shares a browser.
Gotcha. It doesn't go to the
So
next browser when you click
it
over.
doesn't go to the next browser, right?
Yeah.
So it stays on the browser that I was sharing.
All right, perfect. Well, at least we've got that identified now. When we have that issue again, we will take care of it right away. I apologize about that. All right, great job, Deef, bringing that to the Chameleon community. Thank you so much. It's
All right.
Thursday, so we'll have one more webinar this week, tomorrow, Friday. Great job, my friend.
All right, thanks everyone for joining, and hope to see you guys tomorrow. Have a great trading day.
All right, D, have a great day. Thanks, buddy. All right, everyone. Thanks for joining the Market Chameleon webinar series. Everyone, thumbs up, always appreciated. If you are new to the Chameleon community and you ever have a question, you can email support@MarketChameleon.com. I don't know if anyone can join the mayor in Florida, but I put a link to that up higher in the chat, and that is going to be in Miami, I think Mike said. And it's a Schwab webinar or a educational series, a lot of options and futures being talked about from what it looks like. But click on that link if you are close to Miami or have any interest going to Miami. It's there. If you're new to the Chameleon community, you can just take a free webinar or a free try the Market Chameleon product. Just click on trial and you get a free 7-day trial. So that is always helpful to the Chameleon community. With that, everyone, have a great day, and we will see you tomorrow, hopefully, at the same time, 9 a.m. Have a great day, everyone. Thumbs up, always appreciated. Bye.